Good afternoon, everybody. Welcome to a special edition of the Money Hour. Today, we are doing a special edition here talking about life insurance awareness. And I've been doing a series of these interviews where I've been talking to life insurance agents. By the way, my name is Kamari Ellis. If you're just tuning in to this channel, I talk about everything wealth oriented, right? Wealth, taxes, investments, cash flow management, all of the above. And so today I wanted to talk to a buddy of mine, Mr. Curtis May, and I can't think of Curtis's company off the top of my head. I just had it.
Practical Wealth Advisors.
For Practical Wealth Advisors. And today we are going to talk about a life insurance concept that many people talk about called Infinity Banking. I want to say it's called.
Yeah, it's different names. Infinite Banking, becoming your own banker. I call it the private reserve strategy. There's bank on yourself. There's a few names for cash flow banking.
Right. Right. So we'll go with cash flow banking. My apologies. But yeah, I wanted to do this because it's Life Insurance Awareness Month. I haven't seen a whole lot of people talking about life insurance awareness. I want to say I'm the only one, but I don't want to be the only one because I feel that life insurance is one of those things that is imperative for anybody's financial or wealth accumulation and transfer objectives. So everybody basically needs it. But again, we're not talking about it because I know a lot of people are actually scared of life insurance because you got to talk about dying. Right. Nobody wants to die. And so that becomes a little rough at times.
But everybody's going to die.
But everybody's going to die. Absolutely.
And so it's not if, it's when. But it's really what we emphasize at our firm is the living benefits of insurance. And that's what people don't understand. It is not just about dying. It's really, our clients use insurance to buy real estate, to buy business, to invest in their business, to go on vacation and get all their money back. So there's tons of living benefits with regards to insurance when we talk about the cash flow banking concept done properly. Let me emphasize that because, but go ahead. No.
Well, I was going to say, let's do this, right? Let's talk about why life insurance is important. First and foremost, bare bone, right?
Yep.
It's important because if you die, your income stops, period, point blank, unless you have another way of replacing it, right? And then so if you pass away, many people have life insurance. If you die, they will then come and give you a check. Well, actually, they changed it now. They'll give you a debit card and let you draw money.
Or like a money market account with a check.
A money market account. They don't.
Unfortunately, I've paid probably 12, 15 death claims in my career. So my first one at 24. So I take that part of the business very seriously because I've had to deliver those checks. And and I've never had anybody say they had too much.
Well, but hold that thought, because I want to talk about that. But a bare minimum, right? Let's just say the average American makes roughly $50,000 a year, and it's a young man or a young woman, but let's stick with a man for the day. And he has a wife and he has a family, and let's say he has young children. Those young children could be expected, to live the next 20 years till college, right? So that $50,000 that is no longer coming into the household is $1 million over 20 years. So you have $1 million missing out of your household.
Right.
That could be devastating.
If I was meeting that family,
it is devastating.
Yeah, they would need off on GP, we call it human life value, right? As you know. And I would say they need about $1.2 million of insurance.
That's fair. I feel that everybody should have $1 million. I think with $1 million, you can generate 5%, right? In the market. Now, Curtis don't like the market. Everybody knows I like investments, but you can generate 5% easily without eroding the capital or without spending that $1 million that you got in life insurance. So you can get that $50,000 forever if you do it right. And it's not hard to get 5%.
Because the goal is to build legacy wealth. See, what we do as a community, we start over. Somebody dies, they save.
Hold that point, because I know you're going to go into it. Let's go back to where you had to deliver, you said over 20 claims.
Probably about 15, but yeah.
Oh, I'm sorry, 15. What was that like?
It was scary. My first one, I was 23 or so, and I replaced, or let's say I put a $100,000 policy in a person that had 10, 28 years old, a relative of mine, and they had some weird respiratory situation, and they went to this hospital in West Philly. If I named it, everybody would know. And I go, oh, don't. Why'd you go there?
The one that starts with an M.
Yes. So this is like 80, late 80s, right? And that's a shame. That's probably, I'm sure they're better. And but anyway, so and so the person went in with a cold, not cold or not feeling well. Her mother, and they sent her home. Oh, you just got a bad cold. Sent her home. She sent her back. No, my child is sick. The child, she's 28. And so she got admitted. 12 hours later, she was in intensive care. 12 hours later, she was on a respirator. And 12 hours later, she was dead. Okay. So I get a call like 2:00 in the morning. So has passed away. And, my first thought was, oh, I hope this, I don't know if I can say that. I hope this S works. You know what I mean? Because I didn't know. And I'm scared to death. I'm like, okay. And here's the thing. They only had the policy like 9 months. So in insurance, there's something called a 2-year contestability period. So don't lie on your apps, right? And so they have the right to investigate it. So like, what's up with the insurance? Because they didn't pay right away.
And they investigate because they don't want to pay the claim.
If you lied on the application, because that's an unusual thing. So it turns out it was a fluke thing. She passed away. It took about 5 weeks. And so they gave, I delivered, this one I still gave the checks out, $102,000 because they paid the money plus the interest on top of the money while they were holding it.
Right.
And that changed that family's life. It allowed this person to help retire her mother. Money went into investments, into mutual funds, and which helped pay for the brother's kids' education and the wedding of one of her niece's daughters. I mean, so that's the thing. I did a podcast recently on our show, Practical Wealth Show, and one of the podcast was entitled "Don't Die for Free." GoFundMe is not a plan.
Right. So by having coverage on your family member, there was able to be something left, right? And you were talking about legacy wealth. And so from that, a legacy, I don't know how big or how small, but that doesn't matter. A legacy was created to help the family go forward, whether it's through grieving and also extending and growing that family.
Two things will happen. Let me hit this point. Two things will happen. So you're going to be emotionally devastated, and you're going to be, but you don't want to be emotionally devastated and financially devastated.
Right. That's a whammy.
And so a lot of times our folks, we look at insurance as a necessary evil at best, and it should be your primary foundational thing. Nobody gets out of here alive. And so everybody should be insured. This is what other groups do. You know what I mean?
When you say other groups, you're talking about
other ethnic groups do. I don't know if I want to say that, but other people, they buy insurance. Insurance transfers tax-free. Death benefits are tax-free, right?
Tax-free.
Federal income tax-free.
Yes.
All right. Since I know you're a stickler, not so much. So, but that's a big deal, right? Mm-hmm. And so, and Private probate goes directly to the beneficiaries. And so insurance is the only thing that guarantees what you want to have happen will happen. And it's not a need product, it's a want product. What is it that you want for your family?
So how does your personal banking system help with that?
Okay. So there's two things going on. One of the things that we teach people is that there is actually more opportunity in minimizing the losses in their life than there is trying to pick winning investments. So most people transfer their wealth away. The top 5 transfers of wealth are how you pay your mortgage, taxes, how you fund your retirement plans, how you pay for kids' education, and big ticket purchase. So specifically, 35 cents of every dollar on average leaves most people's households in the form of debt to others, right? And so while we're running around trying to make more money, we're giving our money away because we're giving control of the banking function to other people. We're renting the banking function from Citizens, from Wells Fargo. And I'm not saying you don't need to use the bank, but understand when I say banking, banking is a process. It just happens that life insurance, and let me be specific, the only type, just so people are hearing this, the only type that works for this strategy, in my opinion, and the opinion of the founder of the concept, Nelson Nash, his book, Become Your Own Banker, is dividend paying whole life insurance from mutual companies. These policies predate the IRS by over 100 years. So it's not a tax gimmick, okay?
Right. But explain what the concept is first.
So all right, so the concept is, so here's what banking is. Banking just means creating a pool of capital that you control that can move at cost to meet some needs you have. So that's all banking is. It's a storage function. All right. So now so that's the process. So now what happens is the best platform for that process happens to be permanent life insurance. It is the best place to store cash. Okay. Because of, you get one, your money's in the policies are earning like 4%. You get access to your capital, meaning through policy loans. So you get to collateralize your savings. So that means you can use your money without taking your money out of the investment. So you have liquidity, use, and control of your capital. See, we need access to capital. But if you have $10,000 saved up and you withdraw 5 from your savings, well, that money's gone. And so not only do you have to build it back up to 10, you lost what the money would have become had you left it alone. And see, what they don't teach in personal finance is the concept of opportunity cost. All right. So it's credit protected. It's, you can use it as collateral. I mean, there's like 10 different things I show people why this is the best place to store cash. It's not investment. I hate when people call it investment grade insurance. So now with that concept, the banking concept, once you capitalize your system, meaning you were overfunding permanent insurance. Okay. And I have books, let's
explain what overfunding permanent insurance is.
Good. That's good point. So what happens is, most people will buy a whole life, and this is why they don't get the concept. Even most agents don't really even understand how the contract works. And so if you pay $2,000 a year, what you'll see is you won't see any cash value, which is the savings. So every dollar you spend on permanent insurance, part of it goes to buy the protection, which is the death benefit, and part of it goes into the savings side called the cash value. So if you structure it regularly, you won't see cash value for the first year, 2, 3, depending on the policy. And so when you work with an advisor that knows how to do it, there's a way to get more money in. Almost 60 cents out of every dollar first year can go into the cash value. So I've got a client that'll put in 10,000, they'll have damn near $6,000 in cash value year 1. And by year 3, if they're paying 10, they'll see their cash value go up by 10. They're paying 10, it'll go up by 11. They're paying 10, it'll go up by 15. And
because compound interest is at work at that point.
3 things: compounding, dividends.
Well, I'm including that in compounding.
Okay, so I don't. It's because it's really
just trying to keep it simple.
Yeah. Okay. All right. So compounding. Yeah, let's just say compounding. Right.
Right.
You're gonna call me to find out the detail. But just kidding.
No, he's not, and you should call him to find out the details.
But because it's more to it than that. But it's a safe place to store cash where you've got access to it.
And your money grows tax-free.
And your money grows tax-free, tax-deferred, and you ultimately get it out tax-free. So if you're earning 4% in a tax-free environment, that's the equivalent of earning like 5.5. If you'd have to get 5.5 in a taxable account. And I'm talking about safe, money. I'm not talking about investing. I'm just talking about, so yeah, you should be able to get 4 or 5%. I damn sure can get people 5% somewhere. I know that. And so with no market risk. And so now you've got a foundation of money that, because your best investments, and it protects investors a couple. If you're in equities and you have a downturn in the market and you need some money, you have to sell your shares. The only way to turn that money into cash is to sell the shares. But what if the shares are down? So now if you've got 50 whatever in your cash value, you can access your cash while you give time for the market to go back up. So you can have liquidity so you don't have to liquidate your investments. So that we call it infinite banking because there's so many infinite ways to use it. But we make it the foundation. I teach a system. There's a book that goes along with our clients that if you don't read the book, if you don't do the homework, the videos that we have people read, I will not let you work with me. Okay. I tell them, look, it's your money, ain't my money. It can't be more important to me than it is to you. So there's homework with this. It's not like a gimmick to sell insurance.
Right. So you put the money into insurance. So every everyday worker gets an infinity type policy from you, which is basically a mutual policy or a whole life policy from a mutual company, right?
Right.
So everybody that's watching.
So we want them saving like 10. The goal is like 10% of if you're working, let's say you make $3,000 a year, bring home, can you save $300 a month?
Gotcha. But hold that thought. So if you are putting money into a mutual company, right? So there's mutual companies and then there's stock companies, right?
Yes.
For everybody that's watching. This isn't for me. I'm just letting everybody know.
Right. Uh-huh.
And so the mutual companies tend to pay a higher dividend because they don't have as much cost as stock companies. A great example of a stock company versus a mutual company would be, let's say, a Prudential versus New York Life, which is a mutual company, right? So New York Life would tend to have higher payouts, and that is not an endorsement for either company. I'm just using them as.
So let's be
everybody knows them.
So why we use mutual companies? Mutual companies are nonprofits, right? And so there's stock companies and mutual companies. So stock companies tend to, if your stock companies think shorter term because you've got to meet some analyst number quarterly.
Well, they got to spend more money to do it, right? So mutual companies tend to have more money to pay back to.
Yeah, because what happens is it's a nonprofit. So there is in the charter, the mutual company, see, as a policyholder, I'm an owner of the company. That's what mutual is, right? And so what happens is they have to give the surplus back to the owner. So after they pay the bills, the death claims, the salaries, then the extra comes back to us as a dividend. So that means they're thinking like 100-year time block. So we're not making short-term decisions to goose the stock price. And B, we're on the same page. And I want them to make money because, hell, I own the company. Right. Okay. So it's like a credit union. You're a member and
you're an owner.
You're owners, right? So that's why I like mutual companies. We're on the same page and I'm participating. I get to participate in the profitability of the company that's insuring me. You can't beat that.
Right. But then, so once we're putting this money in, right, who is this ideal for? Is it ideal for, a working mom that might be a cleaning lady, maybe making $35,000 to $40,000 a year? Is it ideal for, lawyers, doctors, and engineers that might have 6-figure incomes? Who is this ideal for?
All of the above. Okay. It's not. See, so people think, it's just rich people. This is for investors. I have all of the above because it's a savings strategy, right? So one of the questions that I ask people is, where do you store your cash? And so if you're making $2,000 a month, can you say, I want people saving 10 to 20% of their net pay. So if you're a business, I want gross. All right. And I teach business on how to create an alternative system of financing. That's a longer discussion. But what happens is what we want to be able to do is get you saving, and I'm kind of forcing you to save money and getting more and more control of the banking system in your life. Because if you think about, here's what people do. They'll go buy a car and they will, I don't want to spend insurance. I'm going to look at this $50 a month insurance plan. But they'll spend $300 on a car payment. right? Well, where do you think the finance company got the money to, you know what I mean, to loan the finance people the money to get for you to get the car? There's only one pool of money. It's controlled by banks, Wall Street, and insurance companies, right? And so what they'll do is they'll borrow money from the insurance company at, let's say, 4 or 5%, and then they mark it up and sell to you for a car loan for 6, 7, or 8. It's coming from the same place. So if you bypass the middleman and put your money there yourself, why couldn't you borrow against your policy? I'm saying against, not from you, because you use your cash value as collateral. They are paying you 4, they charging you 5. Your net cost of funds is 1, and then we teach people to go buy the car or go on vacation or get your transmission fixed. But then the other part of that is, and this is the key of managing, you got to be an honest banker. We're going to teach you how to pay yourself back with interest, right? So if you were to get the money from somewhere else at 8%, then we're going to create a 12 months, 36-month payment plan back to you. So now you're recapturing your money and you're recapturing the interest that you were giving to the financial institutions. And so that is the banking concept. And over time, that is a powerful thing. And I wish we do a screen share. I'll show you an example of that, of just buying cars, taking money.
What else can it be used for? Is it just cars? Can you buy homes?
No. So we teach, our system is, we call it money for life system. So it's basically get money, bank it, borrow it, spend it, repay it. So I use a book called Money for Life as our textbook. So, get money obviously is making money. Bank it means save it somewhere, allows you to be the bank, permanent life insurance. Borrow it, use your money as collateral, spend it. So let's talk about spending. What can you spend it on? Depreciating assets, right? Cars, vacations.
We don't want to do, what about appreciating assets?
Okay, but here's the thing. When you buy that, if you can get your money back, so you're going to spend money, right? So you want to recapture. See, the first thing I said, there's more opportunity in minimizing your losses. So if you can get back that 35% that you're giving away to somebody else's bank, you're halfway to the winner's circle if you just do that. Now you can turn around and you can use it for appreciating assets. So for example, I have a client, he calls me up, he goes, Curtis, I did a good person going to show also. I just bought an ATM machine. I'm like, what? I didn't know you could do that. And so they're like $2,000. So next thing I know is I got 3. So over a period of 18 months, and I had him saving like $500 a month in a plane, had it for a few years. And while he was teaching himself, when he found opportunities, he had the cash to do something with it, because I had him doing this 3-4 years already, right? And so he bought an ATM. They're like $2,000. He's got 8 of them. They make $400 to $600 a month per machine. So now, it's get money, bank it, borrow it, spend it, repay it. So when the money never stopped making money, and then he's turning around and use it for something else. So now he's turning around, same money, he's flipped it. He now invests in mortgage notes.
Okay.
Right. You could use it to invest in Bitcoin. You could use it to, if you're trading. Yeah. What I would do is I would take a loan. I would take, a loan for $3,000. I would put it in a trading account, right? And then I would trade it. And from my profits, I would pay back my loan. So now I've got my money over here on the left in the policy that never came out. So it's still making money. And then I've got my investment for growth, because you're either investing for growth or cash flow. But ultimately, if you can get all of your money working all the time, it's like flying a plane with the wind at your back. And that's what you want to be able to do. You want to be able to control the environment, because everything we do sits on top of the banking system. And so when you make money, it's going into somebody's bank. Why not yours? Remember, all banking is not about the policy. Here's banking. Banking is think of a Folgers coffee can. I can't get any simpler than that. So if you've got $1,000 in a Folgers coffee can and you take it out and you go spend it, but you put back $100 a month back into that can over the next 12 months. What do you have? You got your 1,000 plus you paid it back with interest. So you have $1,200. That's banking.
Yep.
It just happens to work better with life insurance, because now you get to uninterrupted compounding, because your original money still made money, but you still have the 1,000 plus you have the interest you put in there. That's how simple it is.
Okay. So last question, right? So let's say somebody's putting away, I don't know, the average salary in America is $50,000. So let's say 10% of that, right? So they're putting away $5,000. What year do you think that they'll have more money in than what they spent, right? So if it's 10 years, over 10 years, they would put 50,000 in, right? 5 years would be 25,000. So at what point will, let's say, if we get to year 11,
Let's say years 7 to 10, they'll have put in, let's say if they pay 60,000, they'll probably have about 65.
65 is all right. And I lied. It wasn't the last question. I want to add on.
Okay.
And at what point can you start taking loans against that cash to do?
The way those policies I've had people dump in 50,000.
Well, no.
I know I'm saying, but even so, let's say you're doing
$5,000 a year.
All right, so $5,000 a year. So what happens is $5,000 a year, you probably have, well, let's say just under 3,000 of that would be in cash value the first year. So you could take a policy loan out. I mean, if you did it annually, you could take literally. I've delivered the policy and we've taken out policy loans because one of the strategies that we teach is how to get out of debt. So instead of doubling down your debt and giving away all your money, we dump it into policy. We take a policy loan. We pay off Visa. So your debt is buying the debt back from the bank, and you take the same payment that you were going to get a Visa and you pay it back to your policy loan. So now they're happy. You've improved your debt ratio and you've recaptured all your money. Then you borrow it back out, pay off the next one. So we
can do that in year 2, year 3,
year 6 months, 3 months.
6 months. So we can do it.
Depends on how much you put in there. You can literally do it the next day. I mean, so it's not that's why there's certain policies I don't like because they have surrender charges. You can't touch all the damn money until year 11. That's why I don't use universal life.
Right. And that's the only reason why I am talking to you.
Yeah.
Because I run into jokers. So for the record, people have brought a boatload of insurance from me. I understand insurance, but I don't like insurance. I will say this. I think life insurance is probably the greatest financial tool ever created because it can be used for so many different
financial
things.
Swiss Army. Rich people love insurance.
Right. But, I love the markets, and that's clear. And me and Curtis go back and forth all the time. And so we have a good time because we
see it's where your unique ability, because it's no wrong thing. See, it's not with insurance, it's not either or, it's both, because you don't have to not do markets. You just can borrow the money to invest.
I tell people all the time, there's no such thing usually as a bad financial product. There's bad strategy. There's bad financial strategy.
Yeah, that's right. It's never the product, it's always a strategy. Yes,
most people don't have a high level of financial education. And most people that are out there fronting like they're financial advisors / planners are nothing more than glorified salespeople. And I don't mean that to demean sales folks, but they're only out there to get a commission. And not really.
Well, I tell you, most people know, not to throw them completely under the bus, is that
there's some good ones out there.
They know what their fund manager or their wholesaler taught them.
Yeah, but at either way,
how to sell these products. How to sell this.
Yeah, but
like that with that movie. But let's put some lipstick on his pig and sell it.
Yeah. But we could go all day about that.
I know.
But listen, if this has helped you guys in any way, shape, or form, please share it with somebody who's looking for life insurance options. All right, life insurance is important. I hope you got that from this conversation today. It was short and brief, but I'm going to be doing more of these, and I might start doing more of these past Life Insurance Awareness Month because again, it's a conversation that is desperately needed, especially in our community, the Black community. So I want to thank you for coming on today, Curtis. Please let everybody know where they can find you at.
Yeah. So one thing that we have a podcast called the Practical Wealth Show, where we talk about, money and this kind of stuff and economics and cash flowing. We focus on cash flow with our investment stuff. And you can also text cash flow #ebook to 26786. So that's cash flow #ebook, all one word, to 26786. And we'll send you our ebook, Financial Planning Has Failed. And I teach something called Prosperity Economics. And lastly, you can go to our site, practicalwealthadvisors.com. And we'll also give you like a short little introductory lesson to some of the strategy that we teach. You'll be on our mailing list. We do workshops, webinars, workshops all across the city, and webinars probably monthly. And so we'd love to, we're both financial educators. You know what I mean? And that's
what I consider myself.
Yeah, I consider myself a financial educator because see, what you know today will determine where you'll be at 5 to 10 years from now. And what happens is we're both, as we're talking before we came on the show, see, it's hard to win a game you don't know the rules. And a lot of times in our community, we either play by the wrong rules or we don't know the rules at all. And so you can't win that game. You know, we've got to educate ourselves because if you don't know, you can't teach your kids.
Well, on that note, I can't find a better one to end on. So again,
like a little hype, right? But
no, that's good. That's good. Well, you know how we get. We do this all the time.
We both, right.
Thank you for watching, everyone. Look up Curtis. He's a wealth of knowledge, and he definitely can help you with your life insurance and other financial needs as well. Again, thank you, everyone.
All right. Have a great day, everybody.